Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. SVOL, the Simplify Volatility Premium ETF, has a unique approach that sets it apart from traditional high-income ETFs. Instead of riding the covered call wave, SVOL takes a bold stance and bets against volatility to generate income. Because of its unique approach, SVOL could offer high dividend and risk mitigation to your portfolio. It might sound counterintuitive, but stick with me, and I'll break it down in the remainder of the video. Before we get into the details of SVOL, let's first talk about market volatility. You can think of the volatility as the stock market's way of letting us know how the weather is. We measure this sentiment with a tool called the VIX index. VIX is a real-time index that represents the market's expectations for the relative strength of near-term price changes of the S&P 500 index. When uncertainty and fear rise, the VIX value climbs higher. It usually means the market will experience more turbulence, something many investors would rather avoid. Well, that's precisely what we're going to unpack. The VIX future has an upward sloping shape, where near-term VIX level is less than longer-term VIX level. This makes sense because the VIX measures market volatility, and the longer the expiration date, the more risks a contract carries, and thus the more premium it is compared to the spot price. This pattern, which is known as VIX contango, makes shorting VIX futures profitable. Imagine you, the investor, short a 30-day VIX future at 17. Now assuming nothing catastrophic happens in the next 30 days, and on the expiration date of the future contract, the VIX level stays somewhere close to 15, then you make a profit on the contract. Now because contango exists in the VIX future market most of the time. Shorting VIX futures allows SVOL to generate higher returns compared to traditional covered call ETFs. SVOL is a relatively new player in the investment scene. It was established in May 2021, and it already has $409 million in assets. Now, the expense ratio is a reasonable 0.6%, which translates to $66 in annual fees for every $10,000 invested. But here's where it gets exciting: the dividend yield is an outstanding 16.5%, outperforming many other covered call ETFs. Now, here's the thing: SVOL stands out from other high-income ETFs because it doesn't hold any stocks and doesn't use covered calls. Looking at the fund's holdings, you'll notice it doesn't contain any stocks. Instead, it consists of government bonds, 58%, other assets, 28.5%, corporate bonds, 11%, and a small portion of other investments, less than 2%. This means it doesn't correlate significantly with the overall market, offering a unique advantage for your risk management. And when we talked about market correlation, the key idea here is that when you're building a well-rounded investment portfolio, having assets that don't move in the same direction can help reduce risks. A classic example of this is mixing bonds and stocks, often seen in a 50-50 bond and equity portfolio. It's a way to balance things out and increase stability. We know the SVOL mainly profits by betting against the VIX, which measures current market volatility. It does this by shorting volatility futures. At the same time, it also buys call options if volatility suddenly surges to counter potential losses. Now, volatility futures are like contracts predicting future volatility levels. They come with different expiration dates, just like regular options. Short-term ones can quickly swing in response to immediate events, while longer-term ones are more influenced by broader market trends. These futures usually capture about 75% of the market's fluctuations, providing some protection against volatility spikes. Plus, the fund buys call options on the VIX, using a small portion of its funds to further safeguard its income. So SVOL will pocket profits as long as the market stays calm and in a range. What if the market goes haywire all of a sudden? Is SVOL vulnerable to a volatility spike meltdown? Nope, and here's why. SVOL plays it smart. It only exposes 25% of its assets to shorting volatility futures. The rest is safely tucked away in treasury notes and bills. In its strategy designed 25% inverse VIX exposure attempts to balance the trade-off between maximizing income and minimizing drag from high volatility. This strategy is comparable to what covered call ETFs do, setting aside a portion of their funds for selling covered calls to allow room for capital growth. So, when you combine these three major factors, shorting volatility futures, which captures about 70% of present volatility, smart limit on the size of short positions, and using UVXY call options as a hedge, it significantly enhances the fund's ability to avoid extreme volatility spikes. It's a far better position than outright bet everything against volatility with no safety nets. Since SVOL's inception, it has delivered impressive performance. To put things in perspective, it has significantly outperformed both the S&P 500 and JEPI in terms of total returns. SVOL has returned 28%, whereas the S&P 500 has given about nearly 12%, and JEPI has yielded 15%. That's quite a noteworthy achievement. It's evident that the fund has a remarkable ability to increase in value. This is a key distinction from covered call strategies, which tend to lag behind the broader market. When we look at historical data, SVOL appears to have a stronger potential for delivering returns similar to the overall market, all while offering high distribution yields, something covered call strategies like JEPI struggle to achieve. So, when it comes to returns, this fund is performing exceptionally well. Now, let's talk about risk management. We've discussed the strategies in place to avoid extreme volatility spikes, but how has this fund actually performed when the markets got stormy? Well, in the bear market of 2022, when the markets were experiencing high volatility and sudden spikes, SVOL only saw a 5% drop. In contrast, the S&P 500 took a hit of almost 20%, and it nearly matched JEPI's returns. Clearly, the fund's risk management strategies are effective. Plus, since it's actively managed, the fund manager can adjust short positions to minimize losses. And here's a fun fact. Beta for SVOL beta, a measure of its volatility compared to the overall market, is a mere 0.58. When it's below 1, it means the ETF is less volatile than the overall market, demonstrating its ability to handle market turbulence well. SVOL might not be the right fit for every portfolio, but it presents a unique opportunity to diversify your portfolio and potentially boost your returns. It's not about betting on the apocalypse, it's about leveraging volatility to your advantage in a smart and calculated way. SVOL stays relatively untouched even when the market stumbles. Recent months prove it. While the S&P 500 dipped, SVOL soared. To put SVOL's performance in perspective, let's compare how it stands against S&P 500. Since SVOL's inception in 2021, S&P 500 delivered 12.01% total return, an annualized return of 4.94% per year. While S&P 500's return is quite impressive, it still falls short of SVOL's annual return of 10.48% for the same period. And that wraps it up for today. If you found this video helpful, don't forget to hit that subscribe button and give us a thumbs up. It really helps out the channel. Thanks for tuning in, and I'll catch you in the next one. Bye for now.